June 2026 just started, and if you have any exposure to silver or you've been thinking about it, you need to hear what's happening right now. Because the signals converging this month are not subtle. They are the kind of signals that, historically, have preceded some of the sharpest moves in the entire precious metals market. And most people are completely unprepared. What we're seeing right now is a collision of monetary policy pressure, geopolitical tension, industrial demand shock, and a paper silver market that is sitting on a fault line. And June 2026 may be the month it all starts to crack. Stay with me, because what I'm about to walk you through could completely change how you're thinking about your wealth right now. Let's start with the macro picture, because context is everything here. The European Central Bank has spent the better part of the last 18 months trapped in an impossible position. Inflation across the Eurozone has refused to fully retreat. Energy prices remain elevated. Government debt loads in France, Italy, and Spain have continued to grow at a pace that is becoming structurally dangerous. And the ECB is now facing a scenario where cutting rates aggressively risks reigniting inflation, but keeping rates high risks triggering a sovereign debt spiral in southern Europe. There is no clean exit from this position. And here is what almost nobody is talking about. When central banks are trapped, real assets historically win. Every single time. Gold has been the more obvious beneficiary in recent months, breaking through levels that seemed impossible just 2 years ago. But silver has been quietly building pressure underneath the surface, and that pressure is now reaching a critical point. Across the Atlantic, the Federal Reserve is facing its own version of the same crisis. The United States government is running a deficit that is structurally embedded into the system. Interest payments on federal debt are now consuming a larger share of government revenue than at almost any point in modern history. The Fed cannot raise rates aggressively without making that debt crisis dramatically worse. And it cannot cut rates without risking a resurgence of inflation that is already punishing middle-class families across the country. What this means for silver is profound. In an environment where both the dollar and the euro are being quietly debased, where real interest rates remain suppressed or negative after inflation adjustments, the historical case for hard assets becomes overwhelming. And silver sits at a unique intersection that gold simply does not occupy. Now pay close attention, because this is where the story gets serious. Silver is not just a monetary metal. It is one of the most industrially critical materials on Earth. The green energy transition, which governments across Europe and North America have legislated as policy, is not slowing down. It is accelerating. Every solar panel requires silver. Every electric vehicle contains silver in quantities that would have seemed extraordinary a decade ago. Every next-generation semiconductor, every advanced medical device, every weapon system in NATO's accelerating defense buildup uses silver in ways that are not replaceable with cheaper substitutes. And here is the supply reality that should make every serious investor stop and reconsider their positioning. Silver mine production has not kept pace with demand growth. Major silver-producing regions in Latin America have faced political instability, regulatory interference, and declining ore grades simultaneously. New mine development takes years, sometimes over a decade, from discovery to production. There is no switch that can be flipped to suddenly increase the supply of silver in the market. The physical tightness that has been building for years is now beginning to show up in places that are very difficult to ignore. Let's talk about COMEX, because this is where the paper meets the physical, and the tension there right now is significant. COMEX registered silver inventories, the metal actually available for delivery, have been declining over the past several months. Meanwhile, open interest, the amount of speculative and institutional paper exposure to silver, remains extremely elevated. This is a structural imbalance. When more paper claims exist than physical metal available to settle them, the market is sitting on a potential disruptive event. It does not always trigger immediately. But when it does trigger, the moves are fast, sharp, and dramatic. We saw versions of this dynamic before the major silver runs in 2011 and in 2020. And right now, the setup looks arguably more compelling than either of those periods, because the underlying fundamentals are stronger. This is exactly why smart money is moving early. Institutional investors are not waiting for silver to break out before positioning. They are building positions while retail attention is still focused elsewhere. By the time silver makes headlines on mainstream financial media, the early move will already be history. June 2026 is presenting what may be a narrow window before that institutional positioning becomes visible to everyone else. Now let's look at the geopolitical dimension, because it is directly relevant to what silver does next. The conflict dynamics in Eastern Europe remain unresolved. Tensions in the Middle East have not eased. The trade relationship between the United States and China continues to deteriorate in ways that have direct implications for commodity supply chains. China, which is both one of the largest silver consumers and a critical link in global industrial supply chains, has been making strategic moves in the commodities space that suggest a longer-term view of resource security. When the world's second largest economy starts treating silver as a strategic resource rather than simply a commodity input, that changes the demand equation in ways that most Western analysts have been slow to appreciate. What happens next could shock most investors. If even a modest portion of the institutional capital currently sitting in negative real return bonds begins rotating towards silver, the demand shock would be extraordinary. We are talking about a market that, compared to gold, equity markets, or the bond market, is tiny. It takes very little capital rotation to produce very large price movements in silver. And that asymmetry is exactly what makes this moment so important for investors who are paying attention. Let's talk about the realistic scenarios here, because I think it is important to give you a complete picture. In the bullish scenario, which I believe the weight of evidence currently supports, silver breaks above its recent technical resistance levels over the coming weeks, driven by a combination of physical demand, institutional buying, dollar weakness following any dovish Fed signaling, and continued momentum in the solar and EV sectors. In this scenario, the move could be significant and move faster than most people expect, because the market structure is already stretched. In the more cautious scenario, if macroeconomic data in the United States unexpectedly shows a rapid cooling of inflation alongside a collapse in industrial demand, the case for silver becomes temporarily weaker. A risk-off event where investors sell everything, including metals, to raise cash, could produce a short-term pullback. But here is the critical point about that bearish scenario. It would likely be temporary, because the structural supply deficit does not disappear during risk-off events. Physical demand from industrial users does not stop because a hedge fund needed to liquidate quickly. Every pullback in this environment has historically been a loading opportunity for investors who understand the fundamentals. And there is one more thing I want to say directly to European viewers, because it is particularly relevant to you. If you are holding significant savings in euros, you are already experiencing the effects of a currency that has lost purchasing power quietly and consistently over the past several years. The ECB's own policies have engineered this outcome. Keeping rates low to protect over-leveraged governments has come at a direct cost to ordinary savers. Silver priced in euros has already delivered meaningful returns over the past 2 years. But the conditions that drove those returns, fiscal excess, monetary suppression, structural inflation, are not going away. If anything, they are intensifying. The question is not whether silver is a relevant asset in this environment. The question is how much time you have left to position before the broader market catches on. Here's the summary of everything I want you to take from this. The macro environment in Europe and globally is tilting toward hard assets in a way that may not be reversible in the near term. Silver is sitting at the intersection of monetary demand and explosive industrial demand at a moment when physical supply is tightening. COMEX data is flashing structural warnings that have preceded major price events before. Institutional money is moving early and quietly. June 2026 is shaping up to be a month where the story of silver in this decade starts to become impossible to ignore. The window to position ahead of the wider conversation is open right now, but it will not stay open indefinitely. Do your own research. Talk to a financial advisor if you need personalized guidance, but do not sleepwalk through a moment that history may look back on as genuinely significant for precious metals investors. If this analysis gave you something to think about, subscribe to this channel and turn on notifications so you never miss an update when conditions change. Drop gold or silver in the comments right now and tell us which metal you believe is the smarter position heading into the second half of 2026. The conversation is just getting started.